The best investors don't fear market crashes, they use them. Because hidden inside every market crash are some of the best opportunities you'll ever see. But only if you know exactly what to look for.
All right, welcome. In today's explainer, we're going to talk about how to turn market fear into a real strategic advantage. We're going to build a powerful 9-point checklist that's designed to help you confidently find high-quality companies even when everything feels chaotic. This is all about finding strength right in the middle of all the uncertainty. Okay, so let's just dive right in. A falling market, it feels scary, doesn't it? But here's the thing. It's often the absolute best time to find incredible businesses at a big discount. The real challenge, though, is cutting through all that noise to separate the truly solid companies from the ones that are just getting dragged down with everything else. So how do we find those hidden gems? We're going to build a simple but really effective 3-part framework. First, we're going to analyze the people who are actually running the company. Next, we'll analyze the business itself, what it does. And finally, we'll get into the numbers for a serious reality check. Stick with me, because at the end, we'll combine all of this into one super powerful checklist.
Let's start with part 1, analyzing the people. Think about it this way. Before you would lend money to a friend, you'd think about their character, their reliability, right? Well, investing is really no different. You are literally entrusting your money to the people running the business. So before we even peek at a financial statement, we have to understand who they are and what really drives them.
So for the people running the show, we've got 3 crucial checks. First, is there promoter buying? Are the insiders putting their own money where their mouth is? Second, what's their legacy mindset? Are they building a company that's meant to last for generations, or are they just looking for a quick sale? And third, do they have a safety obsession? Do they care more about protecting the business than just reckless growth? So our very first check is promoter buying. Promoters, these are the key insiders. We're talking founders and the core management team. When they use their own personal money to buy more shares of their own company, especially when the market is tanking, that is a massive vote of confidence. Actions speak louder than words, and that action is basically screaming that they believe the stock is way undervalued.
Now, the key point here is that we're looking for substantial buying. This isn't about some tiny purchase they make just for a press release. We want to see a real pattern of significant investment over the last few quarters. That tells us that they see some deep value that the rest of the market, in its fear, is completely overlooking.
Next up is the legacy mindset. In a world that's full of this build and sell mentality, create a business, get some venture capital, and get out in a few years, we are looking for the absolute opposite. We want leaders who are in it for the long haul. People who are focused on building a durable, multi-generational business. They're building a legacy, not just a lottery ticket.
So how do you actually check for this? Well, you have to look at their history. Have they just been hopping from one hot trend to the next, always chasing the latest thing? Or have they dedicated 20, 30, maybe even 40 years to mastering one single business? Their history is going to reveal their true motivation. And the final people check, a paranoid obsession with safety. Look, in tough economic times, just preserving the company is way more important than chasing crazy growth. We want leaders who are constantly thinking about what could go wrong and are actively working to fix those risks, instead of taking on huge amounts of debt to chase short-term wins. In this case, being conservative is a very, very good thing.
Okay, on to part 2, analyze the business. Once we feel like we can trust the people, we need to analyze the business they're actually running. You know what they say. A great jockey on a weak horse still isn't going to win the race. We need a business that has a strong, resilient, competitive advantage.
For the business itself, we've got 3 more checks. First is their high focus. Is the company just laser-focused on what it does best? Second, what about brand power? Does it have the ability to set its own prices to protect its profits? And third, does it have a defensive nature? Is it selling something people have to buy even in a recession?
First up is focus. In a downturn, I want a management team that isn't trying to distract me with a bunch of shiny new ventures. I want a team that stands up and says, yep, our core business has a temporary problem, and here are the exact steps we're taking to fix it. They save their cash, and they concentrate on what they do best.
Now, this slide just perfectly captures the idea of brand power. Let's take rubber. It's just a basic commodity. But a company like MRF Tires has built such a powerful brand that customers will actually walk into a shop and ask for their tires by name. This is the key. They turned a low-margin commodity into a high-margin branded product. That brand gives them pricing power, which is the ability to pass rising costs on to you, the customer, and protect their profits.
And finally, for the business, look for a defensive nature. We're talking about companies that sell the essentials, things we all need no matter what the economy is doing. Think about basic food, soap, or critical medicines. Their demand stays stable, which provides this essential layer of safety for a cautious investor. Okay, on to part 3, analyzing the numbers. This is the ultimate reality check. We've heard a good story about the people and the business. Now we use the financial data to see if that story is actually true.
First, we absolutely need a justified valuation. The price you pay for a stock has to be grounded in what it actually earns. The analogy on this slide is perfect. You wouldn't pay $1 million for a little shop that only generates a tiny amount of rent. Those earnings provide a fundamental support for the stock price, which makes it a lot less likely to just completely collapse.
Now, to really dig into the quality of a company, we need to understand 2 key numbers. The first one is profit after tax, or PAT. This is the official declared profit that you see on a company's income statement. You can think of this as what the company says it earned. But the second metric, well, this one is the truth serum, cash flow from operations, or CFO. This isn't just some accounting entry. This is the actual cash that flowed into the company's bank account from its main business. A company can report a really high profit on paper, but have zero cash to show for it, and that is a massive red flag. So the key check here is to look over several years and see if the company's CFO is consistently equal to, or even better, greater than its PAT.
This table illustrates the point perfectly. Just look at the left side. A low-quality company can buy revenue by spending a ton of money on marketing. Its revenue might shoot up by 50%, but its profits are weak, and most importantly, its cash flow is negative. Now look at the high-quality company on the right. It has sustainable growth that generates healthy profits and positive cash flow. We are looking for real earnings, not just manufactured revenue.
And all of this leads to our final check on the numbers, self-sufficiency. We want businesses that generate enough cash from their own operations to fund their future growth, because in tough times, bank loans and outside funding could just dry up. A company that doesn't depend on them is infinitely safer.
So there we have it. We've analyzed the people, the business, and the numbers. Now let's pull all of this together into our final actionable checklist. This is really the key takeaway from our entire explainer.
Here it is, your 9-point checklist for finding quality stocks. Let's just run through it. First, the people. 1. Promoters are buying. 2. The leaders have a legacy mindset. 3. They're obsessed with safety. Next, the business. 4. The business is highly focused. 5. It has strong brand power. 6. It sells defensive products. And finally, the numbers. 7. The valuation is justified by earnings. 8. Growth is funded by internal cash. And 9. The quality of earnings is high with cash flow backing up the profits.
And that wraps up our framework. So I'll leave you with a question. Looking at this checklist, which one of these 9 points do you think will most fundamentally change the way you analyze a company from now on? Think about it, because this is the shift from being a short-term speculator to becoming a true long-term investor.
If you want to invest with clarity, not emotion, subscribe. That's what this channel is all about.